For the next panel, I'd like to invite Laura Shin. She's the senior editor at Forbes and the host of the very famous podcast Unchained. She'll invite the rest of the panel. Thank you.
And I will let you all introduce yourselves. We're going to be discussing legal structures, which sounds really boring, but the topic of the last panel also sounded boring, and it's obviously a very exciting topic. Okay, let's just go in order. Matt, why don't you start?
Hi, Matt Corva. I'm a lawyer for a company called ConsenSys. For those of you that don't know us, we're a big company working on Ethereum. We do a lot of enterprise consulting. We do a lot of government consulting. We do a lot of public Ethereum software development, incubate a lot of projects within ConsenSys. I've been at ConsenSys for almost 2 years. I was the first lawyer at ConsenSys, which you can imagine, a company full of people rooted in crypto anarchy and overthrow the world. It's a fun place to be if you're a lawyer. So I've got an interesting perspective of people that truly want to change the world, but I've also learned that the world is not a place that immediately changes overnight, and working as a lawyer there is a lot about following the rules and doing things the right way.
Hi, I'm Reuben Bramanathan. I'm Product Counsel at Coinbase. That means I look at things like what products we can offer, in which jurisdictions, to which types of customers, so everything from the types of tokens we can offer, the types of trading platforms and order types. So we look at Coinbase as a bridge between Finance 1.0 and Finance 2.0. So really our biggest priority is keeping that bridge open and allowing people to move effortlessly from fiat to crypto and between both.
Hi, I'm Josh Klayman. I chair the legal working group of the Wall Street Blockchain Alliance, which is an alliance of about 30 law firms or lawyers from law firms who are focused on the legal issues confronting the blockchain space. I also co-founded and co-lead Morrison & Foerster's Blockchain and Smart Contracts group, which has about 70 lawyers around the world who, among other things, focus on blockchain, smart contracts, and cryptocurrency matters. So right now, I'm very excited about token sales, also about hedge funds potentially trading crypto, and all manner of other blockchain questions.
I'm Karen Ubel. I'm an attorney at Cooley here in Palo Alto. We have worked primarily with a number of ICO issuers and helping them kind of navigate the regulatory landscape and bring to that conversation about 6 years spent at the SEC prior to Cooley in the Division of Corporation Finance, working with Bitcoin at that time as we were considering how to characterize it, and bringing that experience to assisting clients as they kind of navigate this gray regulatory landscape.
My name's Lee Schneider. I'm a financial services and technology lawyer based in New York City. I'm at a law firm called McDermott, Will & Emery. I had the honor and pleasure of working closely with Reuben on Coinbase's securities law framework for blockchain tokens, which is the project that really got me into this space. There were a number of other contributors to that, including Matt down on the other side. And I just want to say, as regards to the last panel, I thought they made a lot of great points, and I was really pleased to see the level of vision and ethics that was being espoused on that panel. It's not something you see every day in the space, and it's very reassuring.
Okay, so in the minutes before starting this panel, I received an email saying that ConsenSys just announced something in a blog post. I actually brought my computer here to see if I could read it, but it's super long, so I did not get to read it. So why don't we have Matt sort of summarize what's going on?
Sure. So what Laura's talking about is something internally at ConsenSys we've dubbed the Brooklyn Project, based on our office in New York being in Brooklyn. We've seen a lot of enthusiasm over the past 2 years involving token sales. We think that token sales are a very valuable thing to the future of technology, to the future of decentralization, to the future of democratization of society. But token sales can be a lot of different things. You can have securities tokens, you can have utility tokens, you can have securities that masquerade as utilities, and you can also have what we are in this industry, we're terrible at naming things, so we came up with this utility token concept, but nobody quite knows what a utility token is. So another thing we're talking about them more recently is consumer tokens, and that tokens tokens can be anything. It can be a software license. They can be any consumptive consumer good. And we fundamentally think there has to be a way to sell these goods to the public without going through securities laws, if there's a way to do that. But the thing that's concerned us over the past 2 years is we've seen the market develop, and some of the concerns that Vinny and Matt brought up on the prior panel. We've seen a lot of bad things happen. We've seen a lot of overexuberance. We've seen a lot of people perpetrate scams. We've seen a lot of fraud. And we think that we need to get back to our roots of who we care about, and we care about consumers. We care about protecting consumers. So we had some success earlier this year with something called the Enterprise Ethereum Alliance, where we built a consortia of enterprises focused on all coming together and building standards about Ethereum technology used in enterprise. And we thought, why don't we do this with best practices in token sales again? So we started a little bit on this with the Coinbase framework last year, and the idea of the Brooklyn project is getting to a place where token sales better protect consumers. So Vinny talked about a couple of things, right? Like transparency in pre-sales, that's a big thing, right? Like no one should have a 10,000% discount. People shouldn't be flipping tokens on consumers. Things like lockups, things like restrictions on trading to reduce the chance of speculation, to reduce harm to consumers. So what we're really focused on there is building an alliance with other blockchain companies, law firms. There's a couple of interesting law schools that are interested. We hope Berkeley's going to get involved as well, and regulators. We've had some talks with some folks at the SEC about this. We've had some talks with folks in other government agencies, certainly people all around the world, like the Monetary Authority of Singapore, where people have seen value in these things. But we need to all come together as a place to try and create more clarity and try and create best practices. So that's what the Brooklyn project is. I encourage you to read the blog post. For the next few months, ConsenSys is allocating a ton of resources to this project. We've decided to divert attention away from token sales for the time being and get to a place where we think we can do token sales in a healthier way and a more sustainable way, and it starts with protecting the consumer.
Okay, so one of the points that sort of got maybe kind of slipped in there at the end was like you're basically pausing your token sales, is that?
Yeah, I would call it less of a pause and more of a reallocation of resources. So we constantly survey the market. We constantly pay attention to what's happening both on the consumer front and the regulatory front. We noticed, it'd be hard not to notice increasing attention from the SEC. We think that they're increasingly concerned about what's happening with consumers. We also think that, protecting consumers is a very important thing. They're consumptive goods. They can be regulated by many agencies, including the SEC or the FTC or the CFTC. But bottom line is if you protect consumers, you root out a lot of the fraud, and we think that's a valuable thing, and that's why we're going to allocate resources there before we get back to token sales.
Okay, so let's talk a little bit about how things have changed this year. Vinny obviously sort of referenced this earlier where, there was a period like a year ago, last winter, where there might be kind of like one or two big headline ICOs a month, and then it was like one or two a week, and then it was like one or two that weren't even headline ones every hour. So even in that time, you started with this framework that you guys put together with Coinbase, and it was, kind of like thinking like, oh, how do we do this, right? And then suddenly it's now this big proliferation of things that maybe don't follow that framework. So what do you think has changed? How has the legal thinking changed in the past year?
So I'll go first, but I'd love to hear from everybody else on it. I think one of the things that changed, frankly, and not to pile on the VC bashing, was the arrival of venture capital. The stakes got much higher. The interest got much higher. It all of a sudden became mainstream media. You saw token sales go from 5 and 10 million to 200 million. And the stakes just got much higher for everybody. So that was one of the things where it was just a bunch of crypto anarchists trying to figure out how to do these things and get people interested in their projects to it became a mainstream vehicle. And I think, that enough is cause for, hey, let's make sure we're doing this the right way now that, the stakes are higher.
Maybe I'll just jump in. I agree with you, Matt, that's been a big part of it. Anytime there's popularity in an asset, and then you're going to see lots of different participants come into that asset. One of the things that I like to remind everybody is that blockchain assets are not homogeneous assets. You can structure a blockchain token in many different ways. It can be a representation of a physical asset. It can be representational of an intangible asset. It can be a natively digital asset. And so when you're thinking about all of these things, I think it's important to remember that there's lots of different regulations that may apply. Blockchain is not an industry. Blockchain is a technology. And as a technology, it gets applied in lots of different industries. So you can't just say, oh, let's figure out the securities laws. Oh, they don't apply. Hey, we're done. No more regulation. That's not the way the world works. In the world, we regulate based on the context in which the activity is happening. So if the blockchain application is in the healthcare world, you got to worry about healthcare regulation. If the blockchain application is in the energy sector, you got to worry about energy sector regulation. We can go on and on down the list. But I think that aspect of things is also changing the way people are approaching it in the marketplace.
I think another thing, I mean, it's been said a number of times, is that, you know, when people were first starting out, a lot of people thought of things as the Wild West. And I think one of the things that's changed over the past year is that more and more token sellers are seeking legal counsel. And also, there seems to be less regulatory arbitrage because now countries around the world have spoken out and said, hey, we have laws too, and they may apply. And also with the enforcement action that focused on the DAO, I mean, the SEC made clear that even if you launch a token sale overseas, such as the DAO, which was launched out of Switzerland, that you still have to be mindful of the US securities laws and, of course, other laws if you're marketing, issuing, and selling to US persons and the token happens to be a security. But
so let's talk actually a little bit more about that, because that was just one of the really, you know, it's probably actually the number one biggest sort of regulatory event that happened this year. Like, what were some of your other, you know, for other panelists, what were your big takeaways from that report?
I mean, for me, one of the takeaways obviously was that the SEC was thinking about this, and that, you know, even though there wasn't necessarily a way for them to, providing the 21A report, I think was a way for them to give some guidance to folks without necessarily providing hard lines. It reassured us that thinking about it from the Howey test perspective was the correct perspective, facts and circumstances tests. Even though it's a 46-year-old 1946 case, I mean, it's really still the applicable law here, and how we're all thinking about it. So I think, you know, understanding from that perspective, that, you know, people were at the SEC were aware of what was going on. They were, you know, monitoring it. But I think for me, it also signaled that it was, you know, this is, we're playing in the space. You know, we're aware of it. We're thinking about it, and that kind of a first step.
And one thing I wanted to ask about was, you know, when I read it, I felt like, okay, one thing that's clearly not included in this is this issue of utility tokens. Everybody's trying to structure their token like a utility token. And for those of you who maybe don't know, hopefully you do, but, you know, like an example of a security is something where you're selling it, it's an investment, there's an expectation of profit, and that profit's dependent on this external third party. But with a utility token, I guess you can compare it to maybe like buying an apartment. I think there are actually like some cases, and maybe the SEC will correct me later if I'm wrong about this, but like let's say you buy a condo in Manhattan, and you know, obviously you can expect maybe that someday you will earn some profit from that. But I think some previous court cases have said like, oh, but you know, you're probably purchasing this not for that reason, but for the utility. And so maybe an example of a token like that might be something like the basic attention token, where you're purchasing it so that you can use it to, you know, pay publishers or whatever and not have to view ads. So what do you guys think of this argument? Do you think it's something that, you know, ICOs should be trying to structure their tokens as, or do you think that this is something where the SEC will, you know, say like this isn't, you know, you guys are making this up, that, you know, these are not securities?
So maybe we'll let the SEC answer that when they speak later. So I won't try to speak for them. But look, my basic view, and this is my personally held view, is that because blockchain assets can take pretty much any form, right? It's just the digitization of an asset. And people, I think people forget that, look, Satoshi Nakamoto was trying to solve the double spend problem with digital assets, right? He was trying to make a way, he or she or they were trying to make a way for digital assets to be traded so that you didn't have to worry about whether or not you were getting the real one, right? And that real one could be anything. So when your example, I think the Supreme Court case you're referring to is Foreman, your example about the apartments in New York, right? You could see how you could digitize an apartment, and boy, wouldn't it be so much easier than having to worry about getting title insurance when you buy your house if it's just sitting on a blockchain and everybody knows the provenance of it, right? So these are amazing technologies that will make the digital world accessible to everybody. And so, yes, you can structure a token in a way that is not a security. You can structure a token that represents an ounce of gold. You can structure a token that represents an identity, somebody's identity, right? That's what the Civic guys are doing. You can structure a token that's hospital records. Could you imagine how great it would be if you could just transfer your hospital records to your doctor or your insurance company on the blockchain? These kinds of really cool creative things that people are coming up with as applications of the blockchain technology are opening it up and are going to be situations where the securities laws just don't apply.
And Laura, just in response to your question about whether people should be structuring tokens as utility tokens, I think they should, if they do that, seek legal guidance, right? And many of us on the panel here, or our firms, have been working together to try and provide guidance that we think is reasoned for how one might go about determining whether a token is a security or not. So I think many of us in the industry at various firms and various companies, including those on this panel, are thinking really hard about this. So if someone wants to pursue that sort of path, we're all talking to each other and we're trying to find out the best approach.
Let me just add one thing. So every time I hear the phrase a utility token is not a security, I cringe a little bit. So we kind of made the argument in the paper we released this time last year, that if a token has utility and the purpose for which it is sold is that utility, then it's less likely to be a security. Having said that, there's really no bright line as to when something is a utility token or it isn't. And even if something has utility, the way that it's marketed, the way that it's promoted, the returns that are promised could still make that thing a security. So I think we are really focusing too much on trying to create a bright line around utility tokens when you really have to look at the rights and obligations and the way that each token is marketed separately.
Yeah.
I'm sorry, Matt. I just want to take issue a little bit with something that Reuben said about the way that it's marketed. I mean, look, there are lots of things that are marketed as an investment that are not securities. And we should just be cognizant of that fact. Just because something is an investment doesn't mean it's an investment contract, which is the term of art that's used in the 33 Act and the 34 Act and is the basis on which Howey was decided. So we should just be really careful about saying, oh, hey, this is marketed as something that's going to appreciate in value. There are lots of things that, the Franklin Mint in my lifetime has marketed many coins that they say are going to appreciate in value. And I'm pretty darn sure that the SEC is not going after those guys because those are to say that those are securities. So I just want to be really cautious about that.
It's a good point, but I think if you're designing a token sale and you want to create it in a way that's least likely to be a security, you're going to emphasize the potential future network value, the participation rights that you'll have in the network over any returns that you're going to see in the short term. And I think, you do see those really sketchy ICOs saying, this thing's going to go up 200% in the next week.
And I'm not saying that you should ignore that as altogether as a factor. I'm just saying that if you say, oh, they're saying that's an investment, it must be a security.
Sure.
That's not the right answer. The right answer is wait, slow down. Let's look at the way the token is constructed, what its features and functions are, and then let's figure out if you've got a security.
Yeah. So I think I can address both of these and get back to the SEC DAO report point. So one, the things Reuben mentioned is why we have the Brooklyn Project, right? So make sure that people are following best practices and not misleading consumers because we care about people being protected, because if you don't protect your consumer, you're going to be over-regulated or perhaps appropriately regulated. On the SEC DAO report point, we were thrilled when we read it. I don't know if you guys were as well, because it looked a lot like the Coinbase framework. It cited a lot of the things that we cited, and it was a reaffirmation that we were thinking about it the right way, as I think Lee mentioned. But perhaps the best thing in there, and sort of why you're seeing this as the best thing, is the SEC reiterated that in the U.S., we take a facts and circumstances approach to things. There are no bright line rules that a utility token is not a security, and a security is always, whatever it is. That's really important. As Lee mentioned, these assets are not homogenous. They're sold in different ways. And the fact that we can analyze them on a case-by-case basis is really helpful in sorting out things that are potentially unregistered securities or fraud or whatever they are from things that have a lawful purpose.
Yeah, I agree with you, Matt. I think I also, I guess, agree with everyone with some of what's being said. I think manner of sale is one of the facts and circumstances, right? So it is important, to Reuben's point, but it's not the only thing, to Lee and Matt's point.
So from this point, I want to switch over to the controversial SAFT. Here we are talking about like, oh, here's something that's a security, and then later maybe it can be a commodity or have utility. And earlier in the previous panel, they were saying that, if you sell at the point where, it's closest to having utility, that makes it not a secure, or that's the best time to have a token sale. So I wanted to kind of get your opinion, like Marco Santori, who's one of the top lawyers in the space, he wrote a paper with Protocol Labs, and they were saying basically if you're going to launch before, if you're going to do the sale before the token has utility, then that's a security. And then later, once the network is live, then it's no longer a security. And some critics were saying, oh, how can that be? That's something that's a security at one point magically turns into not a security later. So I'd like to get your opinion on this and what you think of the SAFT.
I worked on the SAFT project with Marco and with Falcoin and Protocol Labs. I think that we talk a lot about the consumptive use, and I like the idea of maybe changing the nomenclature to the consumptive token or things like that. And I think that we also saw that discussion on the idea of when does the token end up in the hands of a retail user or retail holder, pushing that out to that real true consumptive use where people, we believe, are buying that for the purpose of using it to redeem for services and things like that. At that point, we applying the Howey test. I mean, it's a different analysis as opposed to when you're prior to that point. There's a lot of risk, and there's a lot of development work that still needs to be done by the founders, by the company. There's a lot of build out, and taking on that risk and relying on the idea of your founders and the company to really get that development up and running, we think factors into the Howey test in a different way. So that the SAFT, as folks mentioned, is based on the SAFE that is commonly used here, the Y Combinator SAFE. But essentially, it's an agreement for future tokens and a forward contract that's an investment contract. And again, I think in a space where there really wasn't a lot of guidance, and as you heard from our first panel, I think people really wanted to find a way to be compliant, and I think that's why there have been a lot of frameworks that have been developed and have been published in order to try and help issuers find a way to try to be compliant in the absence of any real specific guidance from regulators to hang their hat on. And this was something that we thought really navigated that in a way that made sense, and also was really consistent also with a lot of the policies behind the SEC structures, putting that risk with larger investors, sophisticated investors before the launch of the token where you can actually use it. It really fits into that idea of allocating risk in that to the folks that are able to assess that risk and bear that risk. Disclosure as well is something that we also, it's part of the SAFT process, providing that disclosure to investors so they understand, what the risks are that they're getting through. And again, we thought there was a way to align with many of the policies of the securities regulations, while also kind of helping issuers manage that risk as well.
So I think first, I think what Cooley did with the SAFs and Protocol Labs was great because they started a discussion. We released an article through Cardozo Law School that has some criticisms on the SAFT. We think the SAFT is not necessarily a good thing. We don't think it's consistent with our interpretation of U.S. law. As we talked about earlier, facts and circumstances, no bright line rules. This idea that functionality is your bright line rule seems dangerous and misleading to people. As some of the people on the earlier panel mentioned, we think that the SAFT creates misaligned incentives between projects and consumers and their backers. So if you are a venture investor in a SAFT, and make no mistake, that's who the SAFT is targeted for. It's targeted so the big Silicon Valley VC firms can participate and say that they're not engaging in something unscrupulous because they know what they're buying is a security, and that's fine. That's what they're used to. But when their only incentive then is to get a project to a token sale and they have no lockups and they can flip their tokens on the market, who's not going to do well there? The consumer. It creates misaligned incentives between projects and people, and stuff like that is what we need to look out for. It also creates a false sense of security among projects to say, like, hey, I did a SAFT, everything must be good. When again, we haven't heard that, right? We've heard facts and circumstances. And we also disagree with the functionality point. There are lots of things that have been sold throughout time before they were fully functional. By the way, what's functionality in software? Can anybody tell me when something is functional? I don't know what that means. I don't know that anybody does.
Given all the bugs I have in certain software that I use, I wonder whether or not it's functional.
Yeah, like Apple, right? If you have the new OS, you're probably a little worried about that. But there's somebody beloved in this geography by the name of Elon Musk, and Elon Musk just pre-sold however many Teslas that he'll deliver to you 4 years from now, and you won't have that functionality. And by the way, building a Tesla seems a lot harder than building software, as proven by the Model 3. But you can plop down 250 grand for the fastest car ever that he's saying, which is an interesting proclamation, because what will be the fastest car ever in 2020? I don't know when it's actually released. But the point is that none of this is really grounded in precedent. We haven't seen that. So it rang some alarm bells for us to start saying that this is the bright line rule. We haven't seen Elon Musk prosecuted for unregistered securities by selling Teslas before they're ready. And as far as we can tell, the only difference is that now we have a fungible market, right? There's now a secondary market for goods, and that's what blockchain enables, right? These trustless transfers. But as Lee mentioned, there'll be lots of things on the blockchain, your health records, various software licenses, right? If you can buy a Photoshop license and be able to transfer that to other people, that might create a more efficient economy. So just the idea that there's liquidity now seems scary to us to say just because there's liquidity means that everything must be speculative, everything must be an investment, and therefore we must treat everything like a security. We didn't want to jump there, and we didn't see case law that makes us jump there. We think that there's a facts and circumstances approach to everything.
Just out of curiosity, I want to take the temperature of the room. Okay, everybody who does not have an opinion on the SAFT, raise your hand right now. Okay, now I'll put your hands down, and anybody who didn't raise your hand, raise your hand if you think the SAFT is a good model. Okay, that's like what, 15, 20%? And then raise your hand if you think the SAFT is a bad model. I think it's the same number of people. Okay, all right. I was curious, but what did you want to add?
Go ahead.
Sorry. Maybe let's just steer the conversation a little bit away from the SAFT, because although I applaud Marco and Karen and the folks at IPFS for what they did, because I think, again, it's advancing the conversation here in really important ways. And they didn't come out and say, this must be the law, this is how everybody should do it. They came out and said, hey, here's a model that people should be thinking about, which is very important. I signed on to the Cardozo paper. It reflected a lot of the things that I had been talking about and my contributions to it. But let me just move to address a slightly different point, because there's been both on the last panel and a little bit on this panel some bashing of VC and speculation in the marketplace. And let's just all be clear that speculation is not necessarily a bad thing. Speculation happens in all different kinds of markets all the time. And in fact, there are lots of products that we would never see if somebody didn't speculate on whether or not they would be good products. And maybe I'll just take an example from what might be the old world, which is books, right? In the old days, book retailers would speculate on how many copies of a book they were going to buy, because whether or not that book would be popular, nobody knew. And that kind of speculation is an important part of the economy. So we do need speculators in the market. We do need VCs in the market. I'm not saying that VCs should be entitled to super profits, or I totally understand the ethics arguments that were made on the last panel. But I also just want to caution everybody that if you're always pointing fingers at, quote unquote, the bad speculators, you're going to miss out on a huge part of what goes on in the economy more broadly.
Can I just say something too? I also signed on to the Cardozo blockchain project report. I think one thing, though, I want to point out here is one of the reasons that I think it was important to have a report like that is that when Cooley released, the SAFT project and the white paper, as was noted, it was to promote discussion. It was to say, here's a potential viewpoint, let's build on it, let's get your reactions. And I think what was happening sometimes is that people in the market either didn't hear that or didn't want to hear that. And so they were taking the form, which was intended to be a suggestion, a possibility, not the final, not the one, and using it, or coming to lawyers, such as, for example, people had come to me and said, when I would mention something to them, they'd say, well, you need to get smart on the SAFT, right? So pushing back and saying, hey, no, this is not settled law, this is not a settled perspective, here are some other concerns, here are some other thoughts. We thought that that was very important just to avoid over-reliance. So in no way are we trying to bash anyone at all.
Well, and another thing I think just to mention overall is, I 100% agree that was the point, and I think that was the point also of the Coinbase framework, and is providing some guidance for people to think about and as they move forward, and certainly not a bright line. And I think the other thing to talk about, since this is the legal panel, is none of this is safe, right? I mean, all of this, as you're proceeding through this, is fraught with various risks, and whether you use a SAFT or you use something else. I mean, we don't know the regulatory landscape 6 months from now. We don't know how things are going to be treated, and how you market it and how you do these things. I mean, I think that is hopefully a major takeaway, and I think probably people are already aware of it in general. But the idea here is that there are frameworks. There are we have issuers wanting to be compliant. We have law firms and advisors who are trying to help them on that path. But there's no risk-free, safe path that says, okay, I've got the golden ticket, and I'm all set. So,
and may I just say one very last thing? Just want to be clear. Also, some of us, perhaps not all of us, who signed on to that response report, some of us believe that you could have pre-order and pre-sale agreements, and that you can use those. So it's not to say that you cannot use those.
So I actually think the SAFT is actually a really good model if what you want to do is raise money from a bunch of VCs or early investors who will deliver you value in the early stages of software development. I think where it may fall down is at the later stages, where you actually are trying to kickstart your network and you need a wide variety of participants who are all incentivized to participate in the network, you need to distribute your token to as many people as possible. And what you're really promising them is you're saying, when this network is up and running, and to Lee's point, like where functionality is, and Matt's point, where functionality is not a bright line either. But when there's actually value in the network, then you'll have value as a participant in the network. But until then, we'll give you this token, or you can buy this token that will represent that future value. So if you're actually wanting to kickstart the network and solve the chicken and egg problem, then maybe the SAFT isn't the best model there, and you need a model that allows you to broadly distribute your tokens.
And I just want to add too, I mean, I think we've talked a lot about this 1,000% discount and no lockup. I mean, the SAFT is a negotiable instrument. I mean, it's, the SAFT project did attach, a form of SAFT, but, having done a number of these, I know that they take a number of different forms. Typically there is a discount or a bonus, but I would say more often than not, we are seeing a lockup. And I think, again, just remembering that there's no set terms of a SAFT. No one's prescribed those. It's a negotiable an instrument that the issuer can think about the various how it's going to work for them and what things they need from the and what makes sense for them for their pre-sale investors.
So one thing also that I wanted to bring up was Republic Crypto recently launched an offering that enables ICOs to be compliant with and also sell to non-accredited investors. They're using Jobs Act regulations. What do you think are the pros and cons of going this route?
We've studied the Jobs Act quite extensively for a number of things. But I think to Lee's point, the solution isn't always just treat everything like a security, right? And you may create some problems for yourself if you take a consumer good and you try and stuff it through securities crowdfunding laws. The Jobs Act has lots of great things in it. It has lots of things that need work, right? For those that have looked at the Jobs Act, a lot of the things are just inefficient for companies, right? Like you're going to jump through all these hoops, you're going to spend $5 million to raise $7 million, right? Like does that make much sense? There are things like Regulation A+ that make a ton of sense, and I think we're going to see a lot of projects gravitate towards that way. But not all tokens are created equal, right? If you have a token that is just network-based token as a protocol token and your business doesn't have underlying things that you would want in an equity instrument like profits and dividends, trying to classify it as a security just to do safer crowdfunding when maybe you don't need to do that doesn't necessarily make a ton of sense. But if you're a blockchain-based business that has a revenue model and you want to pay dividends to a token holder, you want to distribute profits to a token holder, doing a security is the only way to do that legally in the US as far as I know. So things like A+ are interesting. The problem that you run into right now that people are trying to solve is the secondary market, right? So where can these things trade? It's not like they're going to show up on NASDAQ right away. There are projects like the T0 project and some others that are working on blockchain-based exchanges that can trade securities tokens. The good thing about things like A+ and some others is that you do get decentralization of purchasing, that you don't have this accredited investor restriction, that we're not bringing over the woes of sort of the traditional public markets where lots of VCs get rich on Snapchat and then it hits the public and the public gets hammered over the head with it, right? So there are lots of opportunities for us to do this in a better way.
So let's actually quickly move through kind of the last topics here. So let's talk about legal structures. Obviously, there's like the foundation model, but then we've also got things like what Vinny's doing with Civic, or ConsenSys, where there's kind of like a more for-profit model. What do you think is the best structure for different types of tokens, and what should teams think about when they're determining that?
I don't know that there is a best model, right? It really depends on, in part, the goals of the team, in part, the way they plan to structure the business, in part, the way they think they're going to best be able to get access to the marketplace. So I think there's a whole host of considerations.
And what are the pros and cons of the different models?
I'm sorry?
What are the pros and cons of the different models?
So maybe I'll just say what I think is the biggest con on, and I don't mean that in the purely pejorative sense, the biggest potential negative by using a nonprofit or a foundation, which is in most U.S. states with nonprofit laws, and I think in many jurisdictions around the world, you're not allowed to use a nonprofit to enrich other people. And so if you are giving tokens, quote unquote, for free to people who worked on the project and it's being done through a nonprofit or a foundation, you just have to be really careful about that enrichment prohibition.
You might run into some governance problems too.
To the list of considerations, I think tax plays a big one, because for a lot of these, offshore, non-U.S. potential structures, if you have owners of equity of the token seller that are based in the U.S. I'm not a tax lawyer, but our tax lawyers advise us that U.S. tax will still matter, particularly when you have to bring the money back in. So I think that should be a big driver, especially now that we know that many jurisdictions around the world have spoken out about having their own securities laws and frameworks. With respect in particular to the Swiss Foundation model, just to build on what was just said, one of the challenges, as I understand it, just having spoken with our Swiss counsel friends, is that part of the biggest strength of the Swiss Foundation model is one of its biggest challenges, which is that it's very hard once formed to change the purpose of that entity. That may be a good thing, that may be a bad thing. Similarly, it may be a good thing or it may be a bad thing that it's very hard for founders to get profits out of the foundation because there actually is a contribution to a foundation. There also is, as I understand it, not being a Swiss lawyer, there are some complications sometimes if you're going to have, say, a pre-order or pre-sale or SAFT agreement, that there are questions as to the enforceability of being able to bind a foundation to do something in the future. So if you say in the future the foundation will deliver to you X tokens, my understanding, again, not a Swiss lawyer, is that the most you can do is really make a recommendation to the Swiss foundation to sell those tokens.
Yeah. So having said all that, I agree with that. One red flag that I have seen a few times now is you have an existing for-profit company doing an ICO and bringing the proceeds of that into the existing company. So maybe they've done a seed round or an angel round, and then, oh, okay, we'll do an ICO and we'll kickstart the business that way. That doesn't make sense. You're supposed to be raising funds to be funding the development of this distributed network or this decentralized application. If you're just pulling those funds into your existing business, that's a huge conflict of interest and a huge red flag.
Yeah, and I just encourage people, don't be cute, right? Like, I don't know, maybe I'm the only one. I love operating in the U.S., right? I trust our courts, I trust our laws, I trust what we can do here. We try to operate within the boundaries of that. I am here not because I love talking, despite how that may seem, but because I want to hear what the SEC has to say, right? I think we want to find a way to do this here. The last token sale we did was a Delaware corporation. We're paying U.S. taxes. We employ people in the United States. If your sole purpose of creating a Swiss foundation is you think it's going to create some sort of regulatory safe haven for you, I think you have probably another story coming for you. We've seen a lot of great reports from a lot of regulators and jurisdictions around the globe. As I mentioned, the Monetary Authority of Singapore released a very informative report on how they'll treat tokens. I think the thing that we were thrilled to see most in there were case studies. This issue of like, do they think there's a utility token? They've said, yes, we do. We haven't seen that in the U.S. I don't know if we'll ever see it. And I understand why we might not see it, but things like that are really helpful to get people feel comfortable in a jurisdiction.
Okay, so we have only a little bit of time before we're going to do a very quick Q&A. So let's just do a lightning round where each of you maybe gives kind of like parting tips for any entrepreneurs who are thinking of doing a token sale. And anyone can start.
I'd say the most important thing to do is have a really good, well thought out white paper and really have focused on what your crypto economy is. Without all of that stuff, it's really hard for us to do the legal analysis. It's going to be hard for lawyers in other countries to do the legal analysis. It's going to be hard for tax accountants to do the tax analysis and help you with your structuring and all that other stuff. So if you come to the lawyers to create something for you, I think you're going to be disappointed in the results.
I would agree with that, and I think as part of that white paper process is really having a clear understanding of what the technological development pieces are going to be for you. Do you have the current resources? What do you need to get there? What's your timeline? And those are the things that are going to help your lawyers and your other advisors assist you in navigating through.
I think to that I would add finding the right team outside of your individual entity. That could mean your legal team of hopefully people who are experienced in the space, also people who can help you do things like KYC, AML, accredited investor checks if that's something that you're going to do. If you're going that route, people who can audit your smart contract, look at your white paper and make sure that it's readable.
Slightly different direction. I think it's important to keep in mind the distinction between protocol and infrastructure level projects and then application level projects. I think we're still so early in the space where we need protocol development. We need infrastructure like exchange, identity, reputation, all these things lower down in the stack before we can really build the applications that blockchain technology promises. I think so many of these decentralized app projects are kind of like a train rolling along, trying to build the railroad in front of them as they go along. And I think that coincidentally, some of the protocol and infrastructure level projects are more likely to have utility than some of the applications.
One, hire a good lawyer. 2, Lee, I'm going to steal your line since you didn't say it. Don't commit fraud. Number 1. And 3, build a good team around you. For a lot of people that are first-time entrepreneurs or even second-time entrepreneurs, the thought of having, 10, 20, $30 million in a bank account overnight leads to a phenomenon I like to call token fever, where rational people make very irrational decisions, all in the name of selling a token. Having a good team around you, good legal team, good advisors, will keep you on the right track and keep you on the right side of the law.
Okay, so we've got like 1 minute maybe for one question. Why don't you go? Oh.
So I imagine you have many clients reaching out, just seeing this as a potential source of capital, whether it's appropriate or not. And so how have you experienced kind of consulting with them, and then situations where you're perhaps advising that a traditional equity or debt fundraising, the SAFE or otherwise, is more appropriate until the company is closer to what we're describing as a the spectrum of a utility token. So I guess just how have you been responding to those sorts of inquiries?
Patiently.
Right. Yeah, I mean, obviously, we get a lot of inquiries with people that think this is a quick, fast cash opportunity. But for folks that maybe the equity or a debt or some kind of note, I mean, fortunately, that's what we have actually specialized in for years. Have been working with them. But a lot of people, unfortunately, are really focused on that idea, and we don't work with everybody. We want to work with people like the folks here that are really trying to be compliant and find ways to be compliant.
Okay, so I think that's actually all the time that we have. So thank you all very much.